even started the thing.
Yeah, come on. What did you say the date was?
It's
Why are you not singing the date anymore? Sing it again.
No.
What?
Wow, straight live, bro.
What's going on?
Come on.
Come on.
Straight live out here.
Straight live, bro.
Yeah, come on.
I spoke to Keish, and even Keish was gassed. He said that you have to watch your gala. You know your Ninja. You have to watch your gala video. The video where you talk about the tokenomics.
Yeah.
Yeah, Keish said that he has to watch it again.
Oh, come on. That's what we do, man.
Come on, bro. Keep each other on our toes.
We do.
He's gassed.
We do.
There ain't no experts out here.
Yeah.
None. Just practitioners.
No,
that's it.
The session was good with Keish yesterday. The DeFi practitioner. I took notes. It was mad. The stuff that he taught me was mad still. The stuff he was telling me how much he was making a living. He was telling me that he was making a living. He was literally making a living doing DeFi.
Bro,
he quit his Amazon job.
Bro, the worst bit is, it's gonna get worse. The amount of what people aren't understanding with DeFi is all of the institutions that are involved now.
Oh shit.
They're all in it, bro. And this is some of the news that I'm gonna cover today. Is that whilst there's whatever going on with the interest rates and you have to always remember the way that the game works. Whenever there's big news and big distraction, there's big moves happening. So the moment I saw this submarine thing, I was like, something's happening that they're trying to distract man from.
Something fishy.
Something is a guanin. Now, it might be an accident, it might be a coincidence, but if you look through historical price patterns, there's always something in the news happening when something major is happening in the financial space. Without fail. But it's what it is. It's what it is. It's what it is. But yeah, let's get into the disclaimer. And let me put the thing out to say that we're live.
Alrighty. Do you want to do it or do you want me to do it?
Yeah, if you do disclaimer, hold up, let me, because I'll just let people know, innit? Alex, disclaimer.
Alex, the financial conspirator. Wait, is it financial conspirator? That's it. Financial navigator. That's it. Financial navigator. Financial conspirator. That's another homie. That's me. Shout out to everyone with the hay fever.
I've got the hay fever. I was mad. You're taking antihistamine.
Must be.
Oh, that reminds me of a bar that I've got.
Alrighty. Yo, what's good, people? It's currently 5 minutes past 8 p.m. UK time. Monday, the 26th of June, 2023. Welcome to another episode of The Game, which is a weekly financial literacy, stocks and crypto webinar where we cover everything and anything stocks, crypto, macroeconomics, live technical analysis. And we have special guests, including but not limited to Web3 founders. To join this free weekly webinar, please go to our Instagram. Sorry, my hay fever is playing up right now. Which is blockchain.sensei on Instagram. Give us a follow and then click our bio. And then, click this link here, which says The Game and NFT Fridays. So, without further ado, let's do a quick disclaimer. All content is for education, information, and entertainment purposes only, and it should not be considered as investment advice or a recommendation to buy, sell, hold any assets nor place any trades. Please always do your own what, guys?
Research.
Yes, sir. Our content is intended and should only be used for informational use only. We've got a sensei in the house. It is very important to do your own analysis before making any investments, which should be based on your own individual circumstances. You should always take independent professional advice from a professional advisor. Dubbin, Mr. Harding, Mr. Alex Codling, aka Financial Navigator, a Sensei, anyone else in the room, anyone else on YouTube, anyone here a financial advisor?
Nope.
Nope.
No financial advisors here.
I'm a fun advisor, but not a financial advisor.
You're a fun advisor. The vibes, man. Alternatively, independently research and verify all and any information you may find in our show that you may wish to rely upon, whether you wish to make an investment decision or otherwise. All investments come with this very important word, which is what, guys?
Risks.
Yes, very risky business. Please do your own research. Neither myself, Dubbin, Sensei, Mr. Harding, Mr. Financial Navigator, everyone else in the room, everyone else on the YouTube are financial advisors, and we do not intend to be perceived or received as financial advisors. However, we're working in collaboration with several accredited financial advisors. If you are unable to mitigate your risk,
and soon to be, let me just put it out there, let me put it into the universe. Soon to be Coots.
Soon to be what?
Coots. We're going to be working with Coots. If man them know who Coots is, man them know who Coots is.
Coots Bank, yeah?
If you don't know who Coots is, yeah, then do a little Google piece and see who Coots
If you
is.
know, you know.
And that's
If you know,
who the boys are going to be working with. Get me? Just little conversations and that. Little pieces are going on. Little movements. Because Coots and that, yeah, don't really know about this block life. And us boys, we're about this block life. You get me? Come on. You get me? Lemma. Let's go.
All right. However, we're working in collaboration with several accredited advisors. If you're unable to mitigate your risk, please contact us immediately so we can refer you to an accredited financial advisor. How do you get in touch? You can email us at hello@blockchainsensei.com. You can tweet us at blockchainsen, or you can DM us on blockchain.sensei. Sometimes we miss some of our DMs because we've got loads of people spamming us. So just leave a comment and say, hey guys, I DM'd you, can have a financial advisor, and we'll refer you to an accredited financial advisor. So on this week's episode of the game, we'll be covering UK inflation rates and what we can do about it. Over to Mr. Harding.
So it's a little bit about the inflation and the interest rates. Right now, they are going absolutely scoobily dooblies. Now, everyone's been led to believe that this is all Theresa May's fault. It's got nothing to do with Theresa May. It's got nothing to do with her. It's got something to do. This problem actually has got nothing to do with any prime minister that's in power now. This problem stems back to 2008. That's how long this has been brewing for. Because I'm going to show you a little image piece. Let me get up the image piece. I think it might have been tweeted. Ninja, if you do the images and I do the bars, that might work.
Yeah, let's go.
Let me just find this little image piece. Here we go. Let me just tweet it out right now. Oh no, it'll be on the. Is it on the Instagram? Hold up with me. I think I put out most of the stuff that I wanted to talk about on the gram. Let me just double check.
Whilst Mr. Harding is doing that, guys, we're super proud to announce that Blockchain Sensei will be speaking at Black Tech Day, which is going to be at LSPU Croydon on August the 19th and August the 20th. Shouts to homie Dexter Sims, who's putting on this event, Mula Cake Clothing. This will be a legendary event. We're helping behind the scenes as well with some stuff, including partnerships and sponsorships, etc. Please make sure you get a ticket at www.blacktechday.com. Tickets are £10, which is absolutely nothing for a 2-day event across 4 floors at London University. Make sure you get your tickets.
All right, it's done. So if you go to the Blockchain Sensei Twitter.
Alrighty. Do that. blockchain. Send.
There we go. So the most recent picture. Most recent. Why has it not done it? Why has it not come through?
Did you tweet it on your personal?
No. Yo, why is it not come through? Let me check this. I definitely didn't tweet on my personal. Or did I? Oh, now it says tweet is sent.
Ah, okay.
It was delayed. Got
All
clocked
right,
in.
refresh.
There we go.
Media.
Yeah, there we go. So this interest problem isn't a new problem. This interest problem stems all the way back, like I said, to 2008. What happened in 2008? There was a massive, let me just come on camera for this massive mistake that the banks were running with property, and they paid the price. In fact, they didn't pay the price. They got rich. They got away with it. Hardly anyone went to prison, but loads of people lost their homes, their savings, their jobs, everything. So it's that banker life, innit? Bank life. You know, if you rob some sweets from Tesco, you can get 5 to 10 years. If you rob millions of pounds from people, you just go to.
Okay, let's not exaggerate. We don't go to jail for 5 to 10 years for sweets in Tesco.
You could do. If you got a little. Yeah, you could do. It happens. It happens because you go in, yeah. And then
That is Mr. Hardy's opinion, not the sense of the blockchain sensei.
No, it can happen. It can happen. You go in, yeah, and the next thing you know, it's this case and that case, and then bad behavior and da 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 da. But you know, it's different lives, different strokes for different folks. But anyway, the point that I'm getting at is that this problem comes from 2008, because if you look at the rest of the timeline, the interest rates fluctuated. They never stayed static for more than 2 years. The interest rates have stayed static since 2008. So that's meant that most people in property have never ever experienced fluctuating interest rates. But guess what? They were inevitably going to move and start fluctuating at some point. Why? Because the one thing we're guaranteed in the world, and in the world of finance especially, is change. Things can't stay the same. So it was very, unfortunately, because this kind of stuff isn't taught in school, people were brainwashed into thinking all the way as far back as 2008 that their mortgage rates were going to stay the same for the 35, 40 years, 25 years that they were going to pay their mortgage. When if they looked back in history and just went and double checked, okay, let me see over the previous 25 years, what kind of fluctuations and volatility was there in the interest rates? But do we think mortgage advisors ever say, so over the last 25 years, there's been a fluctuation and volatility of, let's say, 10 to 20% in the interest rates? I don't think mortgage advisors do that. It's very
most
unlikely.
Mortgage advisors are mortgage salespeople.
Yeah, because they're making their buck off you taking the package, just like most of these advisors. Now, I got no problem with these advisors. They got to do what they got to do. And also, now I want you to just go and Google. You should just go on Google and Google 1970s interest rates, UK. And my thing is, if history likes to repeat itself, and if it can do it once, it can do it again. There you go. Go, yeah, here we go. If you go to base rate graph, oh, why is it not letting me? Yeah, here we go. Hopefully it'll show you. It'll just bring up the graph. We can go to the 1970s. Here we go. There we go. See that? What number is that at the top? What's the highest it got to?
17%.
17.5. Now, if people are worried right now about a little 4%, if you look through history, yes, between the 1700s and the 1800s, the interest rate stayed pretty flat. But after that, it was pretty volatile. Then it had a flat period. Then it's pretty volatile. And then it just went crazy. Now, that would mean after the flat period that we're in now, what should come next? A pretty crazy volatile period with interest rates that could potentially go higher than 17.5. But what happened? This history isn't taught in history lessons in school.
Financial history.
It's not there.
We learn
Mortgage
about King
advisors-
Henry VIII.
Mortgage advisors don't go, oh yeah, by the way, just so you know, if you're getting out this 35-year, 40-year mortgage, there is a potential, because it's happened in the past, that the interest rates could go up to 17.5%. It's happened in the past, so it could happen again. They're not telling people that. So this is the big problem. It's not a new problem. What's happening right now, and it's been happening since the Iraq War, is a pass of the blame. Politicians are just, no one is accepting responsibility. No one is going, you know what? I hold my hand up. I messed up, guys. I messed up. I'll be honest. I messed up. No one's doing that. Everyone's going, oh, it was the guy before me. Oh, now it was the guy before me. Now it's the girl before me. It was them before me. But what's happening is every time someone's doing that, someone's coming in, making some changes, and then making the situation worse. It's like trying to make a cup of tea, not knowing how many sugars you're meant to put in the tea, and everyone's just putting more sugar in the tea. But what they didn't realize is the person that's drinking the tea can't even drink sugar. The diabetic. This is what's happening in the UK. And unfortunately, I think the majority of the UK doesn't even know that the interest rates can go up to 17.5%. They have no idea that that's even a possible number. When they were buying their houses, they had no idea, and it's not their fault. And guess who's going to get away with it?
The bankers.
Bankers. Same old, same old. Now if you go to the Blockchain Sensei Instagram, yep, and you go to the most recent post, the one where I've got multiple, there's some. All I've done is just post facts that are available to everybody. So if you go to,
What? Is there a delay in the upload? What's going? Is it another?
No, it's an old one. It's an old one. So go to the other one of the game. Up. Yeah, there you go. Left. Yeah. And then go to the next image. Okay, cool. So one of the things that's adding to this situation is what has happened. What have we been drumming on about for ages and written a whole blog post about the commercial real estate collapse? And what's happened? HSBC are now leaving Canary Wharf. If HSBC are leaving Canary Wharf, that's a big hole in the middle of Canary Wharf. That's a big hole in the middle of London. That's a lot of foot traffic that you're losing in the middle of Canary Wharf, in the middle of London. How does that get filled? I don't know. I don't think there's an answer. The only answer that I could possibly think of is that somehow that giant HSBC building gets turned into a giant Amazon warehouse where they deploy drones and robots from.
That's actually so hard to imagine because that's like part of the iconic London skyline.
Yep. But guess what? The iconic financial bank doesn't want to be a part of it. So if that's not an indication in the sign, I don't know what is. Okay, so go to the next image.
Is it from today or
Yeah, this is from
is this
today.
in the past week?
This is from today.
Okay, yeah. I've not. This is the first time I'm hearing HSBC is considering leaving Canary Wharf.
So, and again, the Evening Standard, I find so much financial game and stats and facts from the Evening Standard. Whenever I pick it up, I never read the paper. I just go straight to the business bits and skim them and try and find the gold. It's always got tiny little bits of nuggets of gold that people aren't reading, because you have to remember, this newspaper is designed in a certain way. They know that there's some serious movers and players that are going to read this paper, that are moving around Canary Wharf, that are moving around banks, that are moving around. They're going to read stuff and impact the markets. So there's little nuggets in there, like this one. Those that got a 180 grand, those that earn over 180 grand are likely to have had a pay rise of up to 8% last year. Those on 26 grand likely got 4.7% pay rise. So yes, pay rise has gone up, but what we're going to do is we're going to do a little exercise here. We're going to do a little spreadsheet. So Ninja, can you go to a Google Doc and create a brand new Excel spreadsheet for us?
Yeah. Let me start sharing my screen for a second though, because I don't know what's on my Google Drive. 1 second.
Yeah, we go.
Yeah, let me just.
Too many numbers.
Yeah, there might be some sensitive information on that Google Drive. So let me 1 sec. In all the time of the game, we've never loaded up a Google Drive. So this is an Excel spreadsheet on
I know, it's pretty
live.
bad, it's pretty bad.
So 1 sec.
It still shows how much room we've got to grow.
100%. 100%.
Okay, so what I'm going to do with everybody now is do something that I do every single month, and I analyze my cash flow and my spending and all of this. And it's an essential thing that you've got to do. You've got to treat your life like a business, because your life is a business.
It's a business, and it's the hardest business you'll ever manage.
Whether you like it or not, your life is a business. And whether you, big up to my Indian friends and families, the one reason they are the wealthiest people in the UK and own majority of the property in the UK is because they understand life is a business. So what they do as family units is they buy houses together. So what's happening in a lot of other communities, especially English communities, and in especially in the Black Caribbean community, we're not buying houses together as family units. What happens is there's this thing of, oh yeah, I've got to move out and get my own place. But what ends up happening is then that mortgage is then split. Instead of a mortgage that was £400 a month being split by the 4 people in the house, the mom, the dad, the daughter, the son, or however many other siblings or kids there is in the house, paying £100 a month for the mortgage, or paying 400 each and getting that mortgage paid off in 10 years instead of 40. What happens is everyone goes off and pays their own mortgage and makes things difficult for themselves. Meanwhile, that house is in the name of the parents, and guess what was going to happen with that house anyway? It was going to get inherited by the kids anyway, so they might as well contribute to it anyway. And this is the game that the Asian families have clocked. And what they do is, and I know this firsthand because I grew up in Handsworth, which in my school, yeah, like it was very, very mixed. What will happen then is they'll buy cars, and again, they'll rent the cars, or they'll buy the cars outright cash. But guess what? Everyone in the family uses the car. So everyone has access to borrow the Merc when they want, or the young kids can borrow the Merc on the weekend when dad's not using it. So let's write out these things. First thing that we got to figure out is the money that's going out. So just put outgoing. Yeah. And then let's put income on, yep, that one. Cool. And then let's move income across one tab. So to see. Yeah. Now, the first thing, the majority of people's biggest outgoing is their rent or their mortgage. So we're going to put rent/mortgage here. Now, your rent/mortgage for you to get ahead in life should only ever be 20% of what you make. If it's not 20% of what you make in a month, you can't afford it. So what we're going to do is we're going to say that the average person in the UK, their average wage is 28K. So on the right-hand side, put 28K income. Yeah, and then we're going to break that down into what it is monthly. So let's just quickly do that after tax, what that is.
Let's just go to after tax.
Yeah, there's an actual website for it.
After tax calculator. We'll do London since I think it's a little different around the country. Take home tax calculator.
Definitely different around the country. Cool.
Right, you want to see the breakdown of salary for 28, 1, 2, 3. Monthly 2,333.
Cool. I'm just going to join on my laptop. Give me a sec, guys.
Oh no, the Matrix attacked me. It attacked my camera.
No, I don't want us to be teaching this. That's why.
And just disappeared.
Close this.
Oh wait, I'm back. All right, so income, and then what? I'm gonna put monthly here. Oh, what's
You see
going
me?
on?
Max, she's just
Yeah.
she's switching over.
Yeah,
What's
go
up?
back to sharing the screen.
You gotta make me co-host, dude.
Oh, can you hear me?
Yeah. Can you hear me?
Yeah. Go back to sharing that screen.
Yeah, you've disabled. I'm not the co-host anymore.
Oh, what the hell? There we go.
Boom. Income.
So
Can
it
I
should
put-
be
or
back
do you
to
want to put
2,700 it should be a month.
No, because after tax.
Oh, okay. So 2,333. So the rent
Yeah,
and
yeah.
mortgage should be 20% of that.
So with the 20% target, it'll be I mean, this is completely unrealistic, obviously, with London, but 2,333, 2,333 times 0.2, 466.
Yeah.
466 pounds.
Well, you say it's unrealistic, but if you're living in a couple, it's kind of realistic.
Yeah.
It is possible. And spread across a household, it is possible. Okay, cool. So put the rent on the next side, the next column on D. So 466, put that there. Yeah. Cool. And then the next one we're gonna do is bills. So yeah, just put bills. Put that in column E if you want. It doesn't matter how we structure it, but just put it in column E. Yeah. Yeah. Now go down.
Yeah.
Yeah. And in this box, we're gonna put bills. So the average person's bills, when it comes to gas and electric, phone, Netflix, all of that stuff, I would say is probably around £400, £400 to £500 a month. If anyone disagrees with these numbers of it being £400, £500 for bills a month, let me know. Yeah, and then bring it down and put it in the box below next to the put it in E3. Yeah, cool, perfect. Cool. And then food in London, living in London, probably spending about minimum, I think you're getting away with is 350.
Yeah.
Absolute minimum. Yeah. And then the next one is travel. £80 for the month. A little. Nah, I don't believe that's true. You know.
Nah, no way.
Do you know why that's not true? Because the food goes off too quick. That's why that's not true.
I think it's doable.
It's doable, but there you go. 120 including snacks. Yeah, that's possible. But if you're eating out as well here and there, 350, I think is fair. The little Tesco meal deals do add up.
I think that for one person, 120 is doable. If you're only eating the food that you bought.
Okay, we're gonna change food to 180 because everyone's agreeing it's lower. So let's change the food.
It's Michael eating food.
I think it's like for me, it was like 240. And I
Okay.
didn't even eat out a lot.
Exactly. So 180. We'll go with 180. I think that's unrealistic, but yeah, we'll go 180.
It's good budgeting.
Yeah.
Good budgeting.
Nah, see the Sensei. A Sensei is the kind of person that can do intermittent fasting for 4 days. So I'm not having it. This guy cannot eat for 4 days. So of course his food bill is low.
Yeah, it's a bit different. And then next is go travel.
Yeah.
I would say travel average.
TFL. I was racking in a good 200 a month on TFL.
Yeah, easy 300.
Easy. Yeah, we'll go for 300.
That's with no leaving London. That's with no holidays. That's with no taxis.
That's just tapping your oyster, bro.
Yeah, that's just tapping your oyster. That's 300.
I understand why people try bump the train in London.
Yeah.
I don't condone it, but I understand.
And then the final category is called MISC. So it's just
miscellaneous
spending. MISC.
Okay, miscellaneous.
Yeah. So that is just little spendings on stuff that you gotta buy, like the odd t-shirt here and there, the odd bag, the odd little gym pass or whatever. MISC. So that the average person, I'd say, spends probably about 150 to 300 if they're a bad MISC app. 150 minimum. If you live in London,
No, I don't think that's minimum.
150.
150 every month on stupidities.
Nah, it's London. London just throws these random curveballs at you here and there. Do we agree? Do we disagree? This is open for debate.
Yeah, it depends on the person. Like, see me, I don't go out, but you know, people go out and stuff like that. And
it's not going out. It's things like having to replace your trainers, having to get a suit, having to, like, you know, them little things like that.
Mm-hmm.
Or if you've got a car, having to just randomly replace the clutch. You know what I mean? And we haven't put having the car on here because that just makes it even more wild.
Yeah, don't even bother.
Yeah. There's no point. So yeah, right. So all of this is the average person living very humbly. This is not anyone stunting, balling out, having a good time, going clubbing every weekend, going to a little brunch here and there, buying their latest little Gucci piece, buying their little Rolly and whatever. None of that. This is someone being very, very, very conservative, right? So let's add up what that total outgoings is.
All right. 1 second. So all of that put together. Oh, can't even do that. 1 sec. I'm gonna do it in my head.
Toiletries is included in the MISC.
Yeah,
1 sec. I'll do it on there. 1 sec. So we'll do 466 plus 450 because that's in the middle. Plus 180 plus 300 plus 150, 1,546.
We'll go to outgoings, 1,546.
Yeah.
And then put that under the outgoings on the left-hand side. On the very left. Yeah.
Boom.
Boom. Okay, so that leaves, how much does that leave somebody with? The average person. About $1,000 it should leave them with. Disposable.
Definitely know that's not true though, because people are scrimping by
depends
with
on
not $1,000.
No, we've gone on the average of $2,500 a month.
that's not average.
233.
That's not average.
Okay. Well, so
That's what Google says is average.
it's what Google says is average, which we know it's not. The average is bumped up by all these Donnies on 100K, 180K.
Literally, that is not average. People
Okay.
are not making $2,500 a month average.
No, they're not. Okay, so look, 787 before inflation hit the UK, right? Or we can say that this is inflation now, right? But what people have to bear in mind is the compound effect of inflation. It doesn't just hit once, it hits over a period of time. So let's now add 10% of that 787 on top.
As in minus this by 10%.
No, add 10% of that on top of itself.
No, because that's income. Because are you sure?
Yeah,
Are you sure that's
and we're gonna
Alright.
add that to the outgoings. No, not from there, from the 1,546. So 10% of that. Basically,
Oh, yeah. Makes sense. £1,706.
yeah. So then what does that leave somebody with? $632. Okay. Right. So now you start to see the disposable income drops dramatically. Now, the effect this has on the UK is the bit that no one's really paying attention to. If the average person's disposable income in a local community or in an area drops by £100, the impact it has on the community in terms of money velocity is extremely dangerous. Because what happens is, again, money velocity is one of the most important terms. It's how much times money goes around the community. So let's say, for example, someone gets rich, they make 100 grand, they make $1 million, they build a house in that community. Now what's going to happen is they're going to get plumbers in, they're going to get plasterers in, whatever. Those plasterers are going to get paid 50 grand. Those plasterers then are going to pay a carpenter to do something. That carpenter's just been paid 10 grand for that job. Those carpenters, those plasterers are then going to go to the local shops. They're going to go to the local chip shop to get food. They're going to go to the local corner shop to get sweets and drinks and whatever. And it's going to spread around in that community. However, if you start taking away from that bottom line, from that money velocity, it then starts affecting everybody. Now, this is without interest rates. This is with inflation. Now what we're going to do is we're going to go and look at what happens with interest rates going up. So now if you go back to the Instagram, and I recommend everybody go back to that image, the spreadsheet.
Which one?
Go back to the spreadsheet. I highly recommend, one of the best things that was ever told to me is to have a spreadsheet like this, where every single month, at the end of the month, and the end of the quarter, and the end of the year, you assess where you are, and you put in your spendings, you put in your bills, your food, your travel, your misc, and you put it into a little Excel sheet, and then you look at your ups and downs. And then what you then do is a portion of this money should be going towards investments, because again, once you use the compound effect, it's magical. So let's just go on to the compound calculator just to show people the power that people don't have an excuse that it is possible for you to retire a multi-millionaire, and that it is possible for you to get incredible gains. So if we go to the compound calculator, and let's say the matrix is telling you that 10% is a great return, right? When this year alone, Sensei, can you tell us or do the research and find out how much Apple's done this year alone? Alex, if you can find out how much Nvidia's done, or Dubem, if you find out what Nvidia's done this year alone. Alex, can you find out what Amazon's done this year alone, percentage-wise? And Keish, if you can find out what Netflix has done this year alone, and then we'll put them in and put them in the chat. So we're gonna go on the this compound calculator looks weird. I don't like this one. This is some US exchange one. Go to a different one. Yeah, the top one's the one we always use. So whilst everyone goes and gets those answers, because we're making this a group episode, continue with recommended cookies. Okay, cool. So initial investment, just put £2,000, £2,000, because most people in the UK can save up £2,000 before the end of the year, because they do that to buy some shoes, a holiday, whatever. So the interest rate that we're going to say we're aiming for is not 10%, because we know that's more than achievable. We're going to say, because we talk about crypto here, 50% for the year.
Cool. What was that Netflix for the year? How much it did, right?
Yeah. What's it done so far?
Yeah, from annual revenue for 2022 was 6.46% increase.
Okay. Is that what the stock's gone up by?
Let me see what. Wait. Let me see. Let me see. No. Okay, in the past year, it's up 120%. The stock.
Wait, what? Netflix is up 120%.
Yo,
But in the
I'm not
past
gonna
year.
say. I'm not gonna. I've got to say it. I told you so.
In the past year, yeah.
I did a whole episode telling people Netflix. I'm not a financial advisor, but I did say a year ago, Netflix, when we did the big Netflix versus Disney episode, I said, don't sleep on Netflix. I did say.
Wait. Wait. Netflix, what was that? Netflix did 120%.
In the past
year,
yes. In the past year.
In the past year, not since the start of the year. In the past year.
We're doing the past year.
So within a year's period of time, someone today, from investing 1 year ago exactly to this day, would be up 120%.
Yeah. I see it. The bounce.
So then we got Apple doing 32%. Let's do what was Nvidia.
So their annual revenue was from 2023 was 26.974 billion.
What was the percentage gain if you invested this time last year?
The percentage gain from it says
Let's just get the live answer.
It says 0.22 increase from 2022.
Wait, he's getting it.
Right.
Nvidia done 137%.
137%, right? Have we talked about these stocks on the game?
Did.
Yes,
damn right we have. Yeah, watch yourself.
200%.
Amazon's on 13%.
13%. Is it safe to say that that's beating the 10% that we're told that you should be happy with?
Yeah.
Yes. Okay. So is it fair to say that being part of a community like this, doing your own research, learning how to invest, getting 50% in a year is possible? Because we've not even included crypto. Is 50% in a year possible? Do we agree? Yes or no?
Yeah.
Yeah,
Yeah.
buddy.
Yeah, it's possible. Okay, so now let's go to the years. Put in 20 years. Yeah. And deposit amount 200. Because do we think
A
the
month.
average person can deposit £200 a month?
Yeah.
Yes.
Can do a bit of overtime at work, get a little side hustle, do
Yeah.
a bit of Uber Eats.
So calculate. There we go. Someone pretty nice. Someone pretty nice.
That's decent still.
122 mil.
Damn.
Okay, let's say that they don't even get 50%. Let's call it 30% to make it more realistic. And let's not even say it's 200 a month. Let's call it 100 a month. Because
Now,
if you tell me
also,
that £100 a month isn't achievable over 20 years,
what we should also counter into this is inflation.
2.2 mil.
The difference is crazy. Extra £100.
Now, I'm sorry, people hate me when I say this and we have this conversation, but I don't see many people investing in property over 20 years and walking away with 2 mil, 10 mil, 20 mil from paying that small amount monthly. Show me where it's happening. Show me people getting getting the 30% a year on property. And this is just compound, like the compound effect, dollar cost averaging. This isn't even getting out and getting in on.
Yeah.
This is just investing.
No spot selling, buyback, no trades.
So the evidence is there. The evidence that the information is there. But what are most people doing? Because they've not been educated. Let's go back to the Instagram. I hope this is hitting home for people why they got to stay in the game. So it's calculated that 4.4 million people are going to lose their homes because of the rise in interest rates.
Oh my God, that is terrible.
Because 4.4 million people weren't prepared for the interest rate to go to even 4%, let alone 8% that it could go up to. Let's go to the next slide. Now, these are the calculations of what the extra little percentage is doing to people's interest rates. So just so that we've got a bit of context, I'm going to tell you what the actual deposit was on this this calculation. Let me get my original image. Oh, hold up. Give me a sec. There we go. I think the house was 250k. But let me not gas it. Let me get it exactly right. Because gassing it would be wrong. We've got to come with the facts. Okay. So it would be a house that cost 250k, but the deposit was 58k, a 25% deposit. Now, who do we know paying a 25% deposit? Nobody. Nobody's doing that. But these are the kind of numbers that the government wants to put out, or people want to put out to make people feel better. But people ain't paying, ain't getting. No, it's not happening. And remember, the higher you deposit, the lower your interest rate. So the only way people were getting 2%, 3% interest rates is if you were paying 25% deposits. Now, this is based on a 250k house. If you were getting a mortgage in London, your house really wasn't 250k. It was 350k, 40k. So, yeah. So, based on a 25-year term, and again, the more the deposit you paid off, the shorter the term was. Now, we've just worked out what you would have got back from your money investing in the stock market, knowing what you're doing, learning over a period of time, over 20 years. So let's see what's happening here. What's happening here is someone's paying on just a 4% interest rate. Their 250 grand house, they've actually paid 279 grand for it. On a 5% interest rate, they've actually paid 309 grand for it. So they're paying an extra 38%. On a 6% interest rate. So remember, right now we're at 5. And this is where we're going next. 6. 6 means that someone's mortgage payment monthly has gone from £747 a month to £1,136 a month. What does that do to people's disposable income?
It shrinks it because they're paying a higher mortgage, and also the cost of everything else has gone up as well. So
Yep.
they're getting hit twice.
And that is called stagflation, when you're getting hit by interest rates going up and inflation at the same time. So let's go to the next one. 7% would mean, oh, wait, go back to that image. 7% would mean that the person is paying an extra £499 a month. Now, this is where the problem is. Is anyone getting a pay rise of even in line with the interest rates? Nope.
No.
Here's where the other problem is. You see all the credit card debts that most people have got. Guess what goes up as well? The interest rates on them. So people have been absolutely suckered in lockdown by the government doing this whole help to buy scheme, the government doing this whole, oh yeah, interest rates are low, it's 0% interest rates, getting people to sign the contracts, getting people to pay the deposits, and then putting up the interest rate and chiefing people.
Style. Oh my God.
They've completely done people over because they've done it, but they've not provided the education. Which
Green.
I think is really bad. What they should be doing is going, all right, cool. So you want to get this house? Let's work out what the interest rate would be and how much you'd be paying on 14%. Why are they doing that? No. Because if you knew what you would have to pay at 14%, you're now prepared for the worst. You now know, can I actually afford this house? Or am I better off investing in the stock market first, getting my cash up, and then paying a larger deposit on my house, a 30% deposit, so I'm not paying these crazy mortgage rates and I'm not paying them for a crazy long time. There's nothing wrong with property. But I would advise, not as a financial advisor, but as a replication of the most successful families in the UK and the richest ethnograph in the UK, which is Asian families, to buy as families. Because if the interest rate goes up, you're buying together as a family unit. Is it hurting you that bad? Nope. Whereas if you're buying singly, it's a problem. It's a real problem. You're in a trap. And then let's go to the next image about what the government's saying. So the government's basically saying that payments, people that fail to make the payments of their mortgage can switch to a new mortgage deal at the end of their existing fixed rate deal without another affordability check. Lenders should provide well-timed information to help homeowners plan should their current rate be due to end. Lenders will be offered tailored support for anyone struggling to deploy high-quality trained staff to help customers. So basically, the thing is, you're going to get given an extra 6 months to try and sort yourself out financially if you default on your payments. Yeah. But yeah, I just feel the government hasn't taught property correctly to the UK. People that I know that have done business studies don't look at property like this. They don't look at the fluctuation of interest rates. And you have to in the UK because we're one of the only countries with fluctuating interest rates on property. In America, it's one fixed long-term interest rate. So you buy your house at 4, it's 4. That's it for life. None of this like, oh yeah, every 2-3 years, yeah, I've got to get into a new deal. It's like it's designed to mess people up. It's mad. But anyway, next image. I hope this is helping. So the alternative, and what we're going to see a lot of old money doing now, is getting into crypto because they're not going to get the gains that they wanted from property. So where are they going to get their gains from? Because if there's high inflation and you've got 100 mil, 10 mil, a billion, if you've got a billion and inflation's at 10%, you've just lost 100 mil this year. Unless you're investing it and beating the market. But guess what? Is the FTSE beating the market? It is a little bit this year, but do we expect the FTSE to beat the market year on year for then, or do more than 10% for the next 5-10 years? If the entire country is falling apart? Probably not. Now, where can people put their money to make up for those big losses? Oh yeah, this thing called crypto that's recently hit a Bitcoin that's hit a 1-year high recently, where the likes of BlackRock are trying to get a spot Bitcoin ETF, where Invesco are reactivating their Bitcoin spot ETF, where Fidelity are taking over Grayscale's Bitcoin spot ETF. And JP Morgan has expanded its blockchain-based token to euro payments. So, I don't know. You tell me. We've been providing lots of evidence that banks are getting into crypto for the last 2.5 years. Is there sufficient evidence that banks are involved in crypto now?
Yes.
Can anyone say that it's dodgy and it's a bit of a scam? Because the same people that you go to for safety, that you trust to look after your mortgage for your house and your life savings and your pension, they're in crypto.
Mm-hmm.
But yet, we don't want to be in it individually. All right, then. Next image. So, something that I think people should pay a lot of attention to is smart contracts, because smart contracts are probably the best utilization of blockchain technology. And the smart contract platforms with the most number of unique addresses are Binance, Polygon, Ethereum, Tron, Phantom, Algorand, Nia, Flow. Most of these we've done an episode on, apart from Tron, and
we've never really dived into Phantom that much.
Yeah, listen, man, Tron. Listen, I can do a run through on Tron, but it's not going to be that exciting, man.
I think we owe it to the community to cover them too.
Okay, I'll cover Tron.
Okay,
Yeah. Okay. Next episode, Keish can cover Tron. I'll cover Phantom.
Alex, you were saying something?
Yeah. I just lost.
Oh, sorry, say that again.
Oh, I'm okay now. I'm all right now.
Okay, cool. Let's go to the next image. Okay. Again, this time, I think it was about a year ago, we went through the
Eunice.
what did we go through? What was it called? It was the BlackRock blockchain ETF. And we looked at all of the companies that BlackRock were going to have in their ETF. And a lot of them were mining companies. And we did say it's very likely that some of these mining companies are gonna get acquired by BlackRock and they're gonna either go private or they're gonna start pumping crazily. We did say. Now, according to this, one of them, Greenridge Solutions, has done 93% this week alone. Crypto Boss, there was another one called Core Scientific that we mentioned. How much has that done?
A whole heap lot, guy.
Yep.
Got in at 24 cents. It was 71 cents this morning.
There we go. So it's a little bit more,
3x in the bear market. Nice.
a little bit more than the 10% that you've been told that you can get.
Oh no. For the year, cause is up 441%. That was last week. I don't know for this week. Overall, for half the year and for the whole year, it's been up over 400%.
But apparently we're in a bear market. But apparently,
And no,
we're
listen,
in a crypto bear market. Apparently,
December 19th, 2022, that information was given. Well, you know, you had to do your own research, but it was given. You just looked at the episode and did nothing else but do your own research. That stock alone, just one stock, you'll be good.
that stock alone, 400%. Remember, the goal that we put out is 20. Was it 20% per 30% per year? We said, yeah. From that one play, you've now done 10 years of your investing.
Wow.
I'm looking at Core Scientific right now. It's at 82% for this past week.
For the past week.
And note, if I was paying attention, guy, January 3rd, cause was like 4 cents, guy.
And this is the crazy thing, right? People think that they missed out on opportunities. If you missed out on opportunities, and if they're one-time things, why do we keep coming up with new ones?
Let
All
me give a very great lesson from this book. Yeah. Stocks, tech stocks, it wasn't considered abnormal for tech stocks to triple in a day in the late 90s and early noughties.
What book
So
is
when I
that?
see crypto,
The Intelligent Investor.
the Intelligent Investor.
Okay.
So 25 years ago, during the tech boom, it wasn't considered abnormal. So it was within normality. It was within normality, in Wall Street, that tech stocks were tripling in a day. So when you see Bitcoin or Ethereum or altcoin go up by 60%, this has been happening in the market. These kind of gains are not irregular.
They're very
They've been happening for 25 years.
But what happens is people get scared off and told that the market is down. Guess what you're meant to do when the market is down?
Why?
Why? When you see that fear versus greed indicator flip to massively fear, that's, according to Warren Buffett, not my words, I'm not a financial advisor, according to Warren Buffett, that's when you're meant to buy. Now, Warren Buffett is hella up. So, you know, so what do we think is going to happen? I'm hoping this is going to tie up nicely into a bow. What do we think is going to happen when all these people can't afford to pay their mortgages?
You're going to sell out.
Yep, they're going to sell out. And what's going to happen? The prices of property are going to dip. And then guess who's going to buy up all the properties?
All the rich millionaires.
All the rich millionaires and billionaires, most of them that were probably crypto. We're going to see crypto get shorted and crypto will dip.
Are you all saying this is the right? Are you saying this is the right time to sell
for property?
Yeah,
I'm
not saying anything. I'm not a financial advisor.
All right, then you're not a financial advisor. Okay, then.
I won't say it's the time to sell. I won't say it's time to sell. But if you look at London housing prices, they've been going up for about 18 years.
Yeah.
I walk on the street. I walk on the street and I see the amount of houses that is on sale right now. It's scary.
Already.
Yeah.
And it's been 5% interest rate for what? Two days?
That's right.
So The worst is yet to come. But what I would say is it's always a great market to rent because people are going to have to rent now.
Yeah.
Have to. So if you've got a house right now, whether you like it or not, make a spare room. Whether you like it or not, 2 of your kids are going to have to share a room. Whether you like it or not, 1 of your kids is going to have to share a room with you. Whether you like it or not.
Yeah.
Because it's people have got to choose between pride and keeping their home.
Yep.
And that's the bit that kills people in the UK. Pride. That's the bit why people don't get houses with their parents. They get them themselves. Which doesn't, when you actually think about it, doesn't make any sense. Why would you get your own place when you can help your parents pay off their mortgage that you're going to inherit anyway?
Yeah.
Why are you going to make yourself struggle for no reason? Help your parents pay off their mortgage, then go and get another property and rent that out.
It's for sure.
Yeah.
Do it together. That's the way. But anyway, final image.
Wow.
So these are the top 15 best performing large cap cryptocurrencies in the last 7 days. We have Stacks, Bitcoin Cash, Aptos, Bitcoin, Arbitrum, Solana, Nia, Litecoin, Ether, and a few others. But our good friend Stacks, I'm pretty sure that was put out as well. Pretty sure it was. Let me just go and check. I'm sure that was put in the dojo. I don't know if people were paying attention. Let me see. Watch list. Where did we put the watch list? Did we put it on Instagram? Oh no, we didn't. June. It wasn't in the June one. Well, I definitely put it somewhere because I purchased it and I make all my things public. So it's definitely somewhere on the internet that we put it out there somewhere. Because Stacks is in my recurring buys on my dollar cost averaging, like where I don't think about it. I just on Revolut, it just takes it out of my bank account and puts a certain amount into it monthly.
Stacks, yeah.
Yeah. That's Stacks. So Stacks, what it is it's it's a Bitcoin Lightning Network smart contracts. So smart contracts on Bitcoin. What it is.
Well, we've got Mara. A bit of Mara.
Mara.
Yeah.
I don't know about that one, so I can't comment. But yeah, that is the end of today's episode. I hope everyone's
that's
taken value. I'm not a property expert. I'm just putting out facts that are there.
Just a man on the internet.
Just a man on the internet.
right.
Telling people that look what you can do with £100, £200 a month.
Yeah, I appreciate it.
Yeah, man. No worries, no worries. It's just about giving people the belief because people don't realize what's possible.
Yeah, but can I get to talk to you on a one-to-one privately?
Of course. You got my number.
Okay.
I've been here, Alex. I told you when we first and I think it was your son that was at the Wealth Dragons thing, yeah?
Yeah, I remember.
The one that inspired me to start this in the first place.
Serious.
Because I saw what was happening with these Wealth Dragons guys, and I was like,
yeah,
nah, you man are charging way too much for this information.
Man, I'm telling you, I lost a lot of money on this, you know.
Yeah, exactly. Whereas I know a lot of people that the same money that they paid for that course or paid to them guys, A lot of them ain't got 200%, 300% gains.
Yeah.
We're helping people get that for free.
Yeah. Yeah.
So that's why I started this. I was like, nah.
Well, my son is still fuming on this. Is get cheesed off about it.
Yeah, it's a shame because what they've done is exactly what's bad. They then put people off, and then they don't want to be involved in investing.
That's right.
Can I just say something? Can I just put a message out there for anybody who's lost money in the past in the market? For anybody who has overpaid for a course, promising the world and then not getting a return, please, this is not nice, but learn to cut that loss. Because not cutting the loss, not emotionally cutting the loss.
I agree.
It's going to stop you from prospering in the future.
Well, that's what I have done actually.
Good.
Yeah. Good.
Yeah.
Congratulations on cutting the loss. Because it sounds like, I don't know your son, but it sounds like he's still living in the loss.
No. I have cut that loss because I realized it was my fault. I should have known better.
Yeah.
And I move on from there. So I'm more cautious when I do things.
The market will always provide opportunities. Let me give a very, very recent opportunity the market provided. Yeah. Mind you, the opportunity happened, so I'm not saying get in this now. But Phantom, which is a top 100 cryptocurrency that we need to go cover because our chief technical officer is a developer for Phantom. Yeah. Look, you could have bought the Phantom. Anyone could have bought the Phantom dip on the 10th of June.
Yeah.
And be 40% up. Wow. This was 16 days ago. The market presented a 40% opportunity bounce 16 days ago.
Yeah.
The world keeps spinning, and opportunities are always abundant. So
yeah, that's right. You're right.
Guys, can I ask you, is it possible you can cover YFI?
Yeah, Yearn Finance.
Yeah, please.
Yeah. We'll put that in the list. So it was, we said we was going to do Tron, YFI,
Phantom, and YFI. Let's. Do you want to make that the next episode? Tron, Phantom, and YFI. If you want to do YFI, Kish does Tron. I do Phantom.
Okay.
Yeah, that works for me. As long as there's no crazy news between now and then that we're forced to cover. Yeah, I'm cool with that.
Okay.
Cool. Yes, Eunice, you did ask me about Wi-Fi last week, but we had to jump off.
Yeah.
Does anyone have any questions before we part?
Just a quick one.
Yeah.
So I was listening to Raoul Power, Real Vision, on one of his speeches, and he mentioned he read a Twitter thread the other day saying that Richie Sunak could potentially put out stimmy packages, but for people's mortgages every month. So next way of them looking like they're helping you without them helping you as such. I don't know what you guys' thoughts on that would be.
The way that these guys are is you have to remember they're big gangsters. A gangster does not give away weed or cocaine for free.
That's true.
They don't do it. They are not nice for free. If they were nice for free, they would be using their money to buy houses. You'd see them you would see them going viral or on social media all the time for just doing a madness and being nice people. Do we see that?
No.
Nope.
Never.
Actions express your priority. I say this all the time.
Have you also listened to his Everything Code or read about his Everything Code?
Raoul Paul's?
Yeah.
No, I haven't.
So he hasn't released the full lot for free for the public, but it's on their pro crypto / pro thing. I haven't got that, but essentially the only assets to actually outpace monetary debasement over the last decade or whatever it is actually crypto and tech stocks.
There we go.
So it counteracts the fact of, okay, gold is an inflation hedge, this, that, and the other one. Actually, in hindsight, gold's negative over the last 2 decades.
Yep, we've been saying this. It's great, and again, it's when you look at the things that don't do well, they're the things that the masses flock to and think are the safe havens. The masses flock to and believe that property and gold are where you need to be. When you look at the stats and look at the numbers and you look at the history, it's not.
Okay.
And it's unarguable, but people don't like talking about it because it's an awkward conversation, because it's what they've been taught by their families, they've been taught by school, what they've been taught by society, is that this is the way that you do it. When meanwhile, the richest people on the planet, the majority of their wealth comes from real estate, but not real estate through physical property, through real estate, through REITs, which are on the stock market. They're still in property, but they're just not in it in the way that we are. Because they've got safety by doing it through the stock market. They've got the ability to liquidate immediately by doing it through the stock market. And then what they do, once they've made their profit on the stock market, then they go and buy the physical houses. But we're not taught that. Then they go and buy the gold bullion after. But if you're trying to get the gains, which you need to get the gains because of inflation, you can't just survive the last 5 years on 5% gains from gold or from the FTSE or whatever. Like, you're going backwards. Gold did more than that, but it didn't do more than Bitcoin over the last 5 years, did it?
But gold did a big jump like the last couple of years.
It did, but it didn't do more than Tesla.
No, it didn't.
So I mean,
no, but I'm just saying, because you know when we had that conversation with the guys that actually work in gold, and have a gold mine in Africa, like everyone was just excited, crazily.
I think the thing is with gold, it depends on what country you're in.
Yeah.
If you're in the UK, the pound to gold ain't going nowhere. But like we did in a previous episode, the gold, the Indonesian rupee, is doing a madness.
Yeah, exactly. Crazy gains.
So gold is great, real estate is great, but not in this country. Like, buying land and buying property in Indonesia, that's a mad flip if you do it in the right place. Buying, I've seen it firsthand. Buying property in Poland, madness. You're getting your property 5 to 10 years ago for about 120, 150 grand. And in 10 years, it's worth 300K now.
Ooh.
Yeah, that's
Ooh.
actually what happened. There was a big boom with property.
UK property does not do that. Yes, it goes up, but it's not going up by 100%.
I get you.
And that's where everyone's being misguided,
diluted.
Yeah, it's not that. And again, I'm just here to say the facts. And if you do your own research, you'll realize everything I'm saying. I've put all the facts out there. I put them out. That's it. I'm just a fact teller.
Okay.
But yeah, man, great episode today, guys. Thank you for tuning in.
Yeah, very well, very well.
Thank you, guys.
Thank you, guys.
Thanks, I miss you.
Friday.
In a bit. Bye.